And as a consequence, they'll be able to cherry pick, quote unquote, the best deals. From everything you've said, both in the book and just now, that may not be the same approach now in terms of looking for private equity investments as the investor. So, kind of,
Yeah.
what's your take on that?
Yeah, I think that's just wrong. But it's taken in a different potentially context in a different era and time. So let me explain.
Yeah,
When you're a KKR, a Carlisle, and you're raising $25 billion funds, and you've got lots of them, it's really hard to put that money to work. And if you think about buying a business, so a typical private equity firm, let's say they use 8 to 12% of their capital in a fund to buy a company. So let's just use 8%. 10% of a $25 billion fund would be 2.5 billion. So call it 2.2 billion ish, somewhere around there. That's kind of the size, bite that they want to take when they buy a company. Imagine how difficult it's going to be to quadruple that company in size in order to find a 4 times multiple of invested capital exit.
right.
Now compare and contrast that with the lower middle market. You buy a company that's got 15 million of EBITDA and you want to get to 50, or 55, 60. And how much easier is it? Well, I could probably do a half a dozen deals, to a dozen deals in a short period of time, and I can get to a 4 times multiple of invested capital, pretty quickly, and a high IRR.